Excellent. Well, good afternoon, everybody. I'm sorry we're a couple of minutes late. Just getting everything lined up for you. We're gonna start the webinar. So welcome to everybody to this Edison webinar. I'm delighted that we're joined by Alec Letchfield of Hansa Investment Company, who will be talking through the fund. I guess because many of you are joining us, you probably already know the fund very well, but it is, for those that don't know, it is quite unusual in my experience in that it's genuinely run with the long-term view for shareholders, and so that has a sort of family overlay within it, but it's got an ability to look to create value over much longer term. And now that might not suit everybody, but I think it's something that's very important to understand when you do invest in Hansa, that's what the ethos is behind it. The other, just a bit of housekeeping to mention is, again, those of you that are following it, obviously there's quite a major bit of corporate activity going on in the background. Unfortunately, because that is still ongoing, we won't be taking any questions on that. If there are a lot of questions that come in, we are very happy to absorb those, and then as and when the timing is right, obviously from a regulatory point of view, we can then perhaps host a follow-up webinar. But this webinar was very much an opportunity to give Alec an opportunity to present to yourselves about what he's doing within the portfolio, and where he's seen value in the markets. So Alec, I will hand over to you, and then we can help take some questions later on. Thank you.
Well, thank you, Fraser, and very good afternoon to you all. Three things really today. One, we want to talk a little bit about the recent news flow. And as Fraser said, unfortunately, as we are in the middle of a deal situation, we can't cover any specific questions on that. If you do want more detail on that, then I'd refer you to the prospectus on the transaction, or the respective websites of the individual companies. So we'll talk a little bit about recent news flow. We'll talk a bit about how we run money within Hansa Capital Group and within HICL itself, and then perhaps a little bit about why we think we are different within Hansa Capital. And as Fraser said, a lot of it will be on the back of the long-term approach that we use in our management, and that I think confers on us a number of advantages which other people will struggle to replicate, I think. So if we could start and move on to slide 5 of the presentation. So I've got no clicker here, so I'm having to refer to slides, which is fine. So if we go to slide 5 there, effectively, Hansa Investment Company, as is shown historically, has been a rather kind of complex vehicle. We've had a kind of a multi-layered holding company structure. We've had Wilson Sons, which is a Brazilian kind of operating business within it. And, Wilson Sons is a fabulous business, but I think a lot of people looked at the complexity, looked at the structure, looked at the Brazilian asset within it, which is very large. And I think it just wasn't for them. So what we've had is 3 bits of news flow of late. So firstly, we've had the sale by Ocean Wilsons of the Wilson Sons business to MSC. And this has raised for Hansa, or for Ocean Wilsons, over 590 million. So a major sale coming through, generating a lot of cash for the group, and a very, very successful investment over many, many years. So that has happened already. A second announcement was that the Ocean Wilsons Holding Group then tendered 20% of its shares to its shareholders to effectively allow them to, those people who perhaps were in it for the Wilson Sons business, to exit the group and to, kind of take some capital with out of the group. So that was the second part of the deal. And then the final part is the proposed combination between HICL itself and Ocean Wilsons Holdings. And that effectively, if successful, will move us towards the right-hand box there, where you can see we go from this kind of complex structure to a much simpler, much cleaner structure, and I think really kind of moves the investment story on within the group. And if we move to slide 7 on the pack, so I think there are a number of really quite significant advantages from this. One, obviously, you've got the simplification, which we've spoken about already, which I think was a major challenge for the group in the past. Secondly, it creates a large, compelling multi-asset class portfolio. So we go up to over 900 million sterling, over $1 billion of assets within the group. So a much bigger group, putting us within that, what I call that kind of top 3 family office funds, which really have scale and a compelling approach. So that I think is a major benefit moving forward. There is value recognition that as you fold Ocean Wilson's, if we fold Ocean Wilson's into the group, effectively that will remove the discount on the Ocean Wilson's assets. So there's a value kind of recognition process. Another problem in the past has been a lack of liquidity. And again, by bringing the group together, hopefully this will improve the liquidity of the larger group. Reduce fees, so we move from a 1% flat fee to within HICL to a 0.8 on the first 500 million of assets and then 0.7 thereafter. So effectively a much lower fee going forward, particularly if you look at the Ocean Wilson's Holdings investment, which was 1% and a performance fee, and we remove the performance fee in the future as well. And then finally, I think 2 factors. One, we get immediate access to private equity, and it's something that we've started to build within the HICL portfolio. But by bringing Oceans into the HICL portfolio, effectively we move up to about 10% in private equity. A mature private equity portfolio, very successful, very attractive list of funds, which for many investors would be hard to access. And then the very final point would be on the capital allocation, where we will instigate a 2 to 4% buyback program, something which we haven't done in the past, which again should add kind of really quite significant economic value to the group as well. So a number of really kind of compelling reasons for this combination to happen, hopefully in the future. If you turn over to slide 8 of the presentation, what we've produced here is a simulated performance of what HICL and Oceans would have given you. So effectively what we've done here is we've rolled in the private equity from Oceans into the HICL portfolio. And you can see there, one, the size of the group in its new guise, which is above that of the flexible investment company sector. So really kind of quite a meaningful fund. But also if you look at the 3 and 5 year performance, really does kind of compare quite well on a simulated basis to the broader kind of peer group. So I think, kind of it's a really attractive group for the future. So that's the news flow and what we're doing within the group itself. Now, if we turn to the next section, which is our approach and how we manage money within Hansa Investment Company Limited. And so we roll on to slide 10 of the presentation. There we've had 3 core sleeves within Hansa Investment Company. Effectively, we've had a core thematic funds, we've had direct global equities, and we've had diversifying assets. And what we're going to introduce with Ocean Wilson's will be a significant portfolio of private assets, which are of a super high quality and give you access to many funds, which would really be quite hard to access if you weren't operating within the kind of sphere in which we operate. So if we run through those 4 sleeves, the core thematic funds, effectively this is a combination of country funds plus thematic funds. And, really what we're trying to do there is we're trying to pick best-in-class country funds. We will blend both passive and active investments here. Certain markets like the US, which are very hard to outperform in on an active basis, we're very happy to hold passive funds for that one. And what we'll combine it with will be some very active managers on that side. So it'll be names like Select Equity in the kind of the small mid-cap US space. It will also be names like Pershing Square, where you've both got a discount to assets there as well. But but also, you've got great long-term returns there. So that's what you'll get on perhaps the US side. In other markets like Japan, emerging markets, Asia, we strongly believe in the value of active management. So we think there we can identify some really quite fantastic names. So names like Almaraiko, Arcus in Japan, wonderful managers, long-term track records. Both managers have been doing it for a number of years through multiple cycles. So really giving you great kind of long-term returns. And then in the emerging markets, we've got names such as Sam Veck and BlackRock and his Frontiers Fund. We've got James Johnson on Red Wheel. I say, again, great managers, wonderful returns, and, generated returns through multiple different investment cycles. And then finally in Asia, we've got names like Robin Parbrook at Schroders on his Asia fund. And again, a fund that we've known for many years and has generated some great returns. So that's what we're doing on the core side. The thematic side are those sectors which either we want long-term exposure to, like in, say, the technology sector, where we've got an oversized position there in technology, but also certain other sectors like insurance, where we think they become attractive for various reasons. So last year we thought the insurance pricing was becoming much more attractive. Capital had withdrawn from the sector and it created an opportunity. So we put in names like Polar Global Insurance on the thematic side. We also put a group called Nafila on the diversifying asset side, and Rob Royal on the direct global equity side, bought into Arch, again, which is a wonderful US insurer. So that's the core thematic section. On the direct global equity part, this is run by Rob Royal within the team and has done really quite a fabulous job actually for us. Rob runs a highly concentrated, high conviction list of names, looks absolutely nothing like the benchmark. And really what he's looking for are those companies which demonstrate value, which stand on a discount to Rob's kind of perceived kind of intrinsic value within them, and also have alignment, just as we have strong alignment within Hansa itself and what we do. He's looking for those companies which also have strong alignment, which, where the kind of the people running the group are the people also benefiting from the group as well. And also we're long-term again in our approach. So we're not looking to trade this particularly aggressively. The turnover is very low. And as I say, Rob has done a wonderful job here and has generated, really quite fabulous returns. And we'll come back to returns a little bit later on. The third silo or sleeve is our diversifying assets part. And so as a group, we are long-term, and that leaves us to be strongly invested within the equity markets, whether it's public or private. And typically we will have a low allocation to kind of non-equity assets. But occasionally, if we're worried about the cycle, worried about valuations, etc., within markets, we will look to increase our exposure to those assets which will give us a different journey from equity markets. And that's a diversifying asset. So we put this in place in about 2017. Historically, most managers would have put bonds here. We looked at this, we thought bond yields were low, interest rates were low, inflation was low. We thought you were getting no return for lots of risk. So therefore we had very little to no bonds within this section. And instead we looked for kind of absolute return hedge funds. We looked at systematic funds. We looked at insurance, i.e. those sectors operating off different economic cycles. And I say, again, this has done a really good job for us, albeit it is very much something that we do on the sidelines for the equities. Now, the new part is what we're doing on private assets. At Hansa Capital Partners, we have been investing in private assets for many, many years. We've got a wonderful address book, wonderful kind of connections within this market. And we think that as more and more companies stay private for longer, less and less companies are going into public markets. If you're running long-term money to be out of the private assets, we think is really missing the important part of the returns that you would hope for within the marketplace. So if the combination is successful, getting a mature list of private assets, I think is a really great thing for the funds, and will move our position up from something like 0.5% in private assets currently, up to 10% overnight. So it'd be a really great return for the fund. So that is our sleeve approach. The way in which we manage this is really on a long-term basis. We're not looking to trade markets. I don't particularly believe in trading around, kind of calling tops in markets, calling bottom markets. Very few people can do this, if any, can do this successfully. And generally, as a group, we believe in sticking with our equities, not looking to trade cycles, and kind of reaping the long-term compounding benefits of equity markets. From time to time, if we are that worried about cycles, valuations, etc., or we see some kind of structural risk, we will increase the diversifying part. But really, that's something that we do very, very rarely and very occasionally. Secondly, we think we are experts in blending assets. So we are great, I think, at kind of pulling together these different asset classes with different attributes and generating a really good return for hopefully kind of limited risk when we do it. So that's another part of what we do. And then finally, it's all about portfolio fulfillment. So a lot of the time the team is spent kind of hunting for new ideas, hunting for those great funds of the future, and looking for those managers with experience of managing through cycles. And it's something which we've done for many years now. So that is the approach to what we do. If we kind of switch on to, say, slide 16, a little bit on the risk management side. We have a multi-pronged approach to risk management. We blend, as I say, high quality managers in the first instance. So we want those managers who've been investing through cycles, through multiple different periods in the market, who've got experience of managing both up and down cycles. So that's our first protection against markets which are more challenging. Secondly, it's the portfolio construction. So the way in which we blend these assets, blending those with, a margin of safety, a degree of kind of valuation protection in what we're doing. All of that, I think, kind of helps us kind of manage the risk. We do have this option on diversifying assets. So, if we are particularly worried about markets, particularly worried about some structural issue, then we can look to add in a larger position within the diversifying assets as well. And then finally, it's not just about investment risk. There are a huge number of kind of operational risks facing kind of funds and markets, and we spend a lot of time questioning our managers on how they manage the operational kind of risks, whether it's cyber, etc. And again, it's something that we're very careful about to make sure that there's no events that kind of come through on an operational perspective. And the final part is that we overlay an external kind of risk management tool through the BlackRock Aladdin analysis. And I think, it provides an external set of eyes looking in at what we're doing, kind of telling us hopefully what we already know. But also for our boards, it gives them an external perspective on what we're doing to say, look, actually, has the manager considered this? Has it considered these different scenarios? So we consider risk, really quite carefully within the broader portfolio. If we then turn to why Hansa, what do we do that we think is different and special in the marketplace? And if we turn on to slide 18, I think we give some kind of sense of that and some sense of why we think we would be attracted to potential investors. The first one is the long-term nature of the group, that by having a stable kind of management within the group, kind of shareholder structure, it does confer on us this advantage of being long-term in our outlook. Many funds claim to do this, pay lip service to being long-term. In practice, most of them do not have the luxury that we have of being such long-term investors. And, reasons why we had great investments like Wilson's was because of this long-term structure within the group and this long-term nature of what we do. The other added advantage of this is that it makes us a highly attractive partner to our funds and people that we're investing in. So if you're investing in the venture capital market, these high quality top 5 venture funds can get exposure or can get access to as much capital as they want. And the reason why they come to a group like us is that one is that we've got the address book and connections to get access in the first place, but also we're just a really attractive partner to them, being sensible, long-term, kind of considered money. And it's meant that we've got access to a number of very attractive names that many people just wouldn't be able to get access to. Second factor is that I think we're truly unconstrained. We do not have a single bespoke benchmark. Most people have a single benchmark, and there's that kind of anchoring effect that historically, from what we found over time, is that you tend to kind of gravitate towards that benchmark, and it means that you're investing in sectors or areas which really you shouldn't be, but you feel obliged to because of the nature of the benchmark. We instead look at a grouping of key performance indicators, which mean that we can kind of look at things on a considered basis, look very different from the market, and I think offer investors something very different and very unique within the marketplace. So we're truly kind of constrained there. Highly aligned. We are the largest holders of our fund. Any kind of impacts in terms of performance, etc. We are the people most affected by that within our fund. So we're effectively eating our own lunch, unlike many other funds where the internal ownership is quite small and low. Secondly, by having our current kind of ownership structure, it means that we're not subject to the whims of short-term investors or activists. As we've seen over recent months and years, increasingly you are finding short-term people are coming into the marketplace, dictating the agenda of the funds and actually making people do things which, yes, may get some short-term kind of upside, but really leaving huge amounts of value on the table for those prepared to take a longer-term outlook. And the final factor I'd mention is the understanding of multiple asset classes. We're not managing direct insurance funds. We're not managing, direct positions within Japan, for example. But what we do really well, I think, is understand how different asset classes interact with one another, blend together, generate the best possible return for the lowest possible risk. And I think we really do that really quite well. The next few slides kind of give a quick illustration of that. If we flip onto page 19, if we go back a page 19, this one here, the dark blue line here shows the allocation to equities. And as you can see that even when there's been kind of short turndowns in market, whether it's in 2020, 2022, typically we've kept the positioning within the equity markets and generated, much stronger long-term returns on the back of it. So we are generally long-term. We're not just saying we're doing that. We are actually doing that. If you then go on to slide 20, this shows some of the names that we currently have access to within the fund. And I'd say there are people like Khosla Ventures there, which is the Vinod Khosla fund there. It's a venture capital fund run from the West Coast of America, founded by Vinod Khosla, who was one of the co-founders of Sun Microsystems. And this fund has a wonderful reputation for investing in AI, for example. Was the first professional money into ChatGPT and OpenAI. They are probably getting one of the first calls on any new AI companies coming into the marketplace. A wonderful group. Similarly, Mayfield, another top 5 venture group, very hard to get access to. Very few to probably know other managers within London with access to that one. Helicon Investments, a European long-short equity fund, wonderful manager. We found them beginning of last year, super track record, super focused, and, been doing a great job for us. So wonderful names that takes many years really to get access to. So great kind of long-term partner for many groups. If you flip on to slide 21, there we've got the diversifying assets. So slide 21, there we've got the diversifying assets. So this one here shows the allocation of diversifying. So running typically at about 10, 11%. But the dark blue bars at the bottom, I'm sorry you can't see that, but dark blue bars at the bottom show the allocation to bonds. So generally we are really not much exposed to the bond market, whereas most people on the diversifying side would have a considerably higher exposure to the bond market as well. So generally unconstrained there. And then finally, if we go on slide 23, what I just thought I would do here is talk a little bit about what the fund will look like on day one post the combination, and then kind of the aspirational long-term targets where we'll end up. So on day one post the combination, so the left-hand kind of chart there, you can see that we'll have 35% in cash should the combination be successful. And, that will be invested progressively into markets over a period of time. And then secondly, that private equity part. So we go from literally about 0.2% private equity to 10% overnight, which will be a mature private equity fund of the great and the good, well through that J-curve effect and giving you access to many of the great companies that are staying in the private markets for longer. Over a longer term, if you look at the right-hand chart, you can see that the private equity will jump up to about 20% aspirationally. So we do think you need a meaningful exposure there. And then cash will drop down to about 2-3%, typically is what we run within the portfolio. So that will be the kind of journey that hopefully we will be on should the combination be successful in the future. And now if I can just finish off just by really talking a bit about the performance of the fund. So if we flip on to slide 25, there we've shown both the NAV of the fund, but also the share price as well of both HICL plus Ocean Wilson's. And there you can see there that over the last, 3 years, for example, the NAV of the fund of HICL has been 8.1%, excluding Ocean Wilson, so excluding the Wilson's uplift. And that compares to the 60-40 equity bond balance portfolio of about 1.7% per annum. So considerably ahead. Similarly on the Ocean side, a similarly kind of, good set of numbers. So really quite compelling numbers, generated in the past. So you're getting exposure to, kind of proven experience of managing assets. Some of the highlights on slide 26 there, you've got names like Helicon, have been one of his last 12 months. So Helicon, wonderful. Rob, Interactive Brokers, wonderful investment. BlackRock Frontiers, all good there. Focusing on Rob on slide 27, here we've shown since inception, Rob took this over kind of April 2017. He, on the direct global equity side, has returned 138%. That is above the MSCI World, which was 115%. And I think what has been particularly impressive about this is that he's done that with little to no exposure to the Magnificent Seven, which is really quite an incredible kind of outcome. I think the last Magnificent Seven name he held was Alphabet back in 2021. So really done this just through holding a very interesting kind of group of high conviction names. So wonderful job there done by Rob on the direct global equity side. And then finally, you've got the diversifying assets on slide 28, where our diversifying sleeve has risen by about 44%. UK government bonds, UK gilts are down by 8.8%, so 50% outperformance there. And we're particularly pleased by the drawdown characteristics. So if you look at the right-hand chart there, you can see that HICL maximum drawdown of a diversifying portfolio has been 4.5%. And that compares to 16 for the MSCI World and 32% for UK gilts. So really, a good outcome there. And then finally, on private assets on slide 29, this is coming from the Ocean Wilson side. This grouping of the last 10, 11 years is up by 230%, and that compares to 177 for the MSCI World. So I will stop there. And so I think we've created a really kind of creating a really compelling group, which is answering many of the questions that we have faced quite right in the past. And any questions, very, very happy to answer them.
Alec, thank you. There are quite a few questions coming in, and some of them are repeating, so I'll try and amalgamate them. And please do keep sending your questions in, and we'll try and get through as many as we can. Can I just start on just your view of markets? I think that's something that's a lot of people are thinking about right now as to where a market is likely to go, what's happening in the US. Do you talk a little bit more about that? Give us a bit more of your thoughts and colour.
Yeah, so obviously Trump has been the main show on this one. So Trump came into power initially, I guess, end of last year, and people were all pro him, pro what he was about being, they perceived him as being pro business, low interest rates, etc. And we saw kind of quite sharp rally on the back of that. I think unfortunately then we got into Q1 and he started unleashing his tariff program, which I think shocked people by scale and scope of what he was doing. So I think people thought he'd found some kind of ideology. He was, prepared to sacrifice growth, possibly cause recession and downturn. And, at the extreme, there were many people kind of panicking or selling out of markets, questioning whether the US hegemony was coming to an end. And we took a slightly more nuanced view on this one. We said, look, clearly, if you look at his first term, he treats everything like a real estate transaction. He goes in hard. He, kind of tries to really force things quite extreme, quite, kind of causes panic and turmoil. Then at the 11th hour, he kind of backtracks from that and goes something that's more reasonable. And that, so we stuck with it. We took the view that the US economy itself, which is key for the world, US economy was in pretty good shape. We didn't see the excesses that you see normally at market peaks. We didn't see the problems within the consumer or the banking sector normally. So valuations were high, but that argument has been the case for many, many years. So we took a more nuanced view, didn't panic, stuck with both our market positioning and to some degree our US positioning. And, luckily that has proved to be the right call at this stage. So we stuck with it and have kept a broadly pro-equity, pro-market approach within the fund.
Thank you. One of the things as well that is interesting is some people sort of like you. I like the idea that you're not benchmarked. It's a much more free reign. You kind of go where you're thinking you're going to be able to add value for your investors. Who are comparators in your sphere? A lot of investors do like to compare. Who do you see as, or maybe not comparators? Who are your peer group in the sort of investment trust, investment company space?
So we obviously sit within the flexible investment company grouping. Clearly, we name is a wonderful fund. So we clearly compare well to people like ROT and Caledonia. Two fabulous funds, share very similar kind of characteristics to us in terms of being multi-asset, having exposure to private assets, and they've done that really, really quite successfully for many years, and really not being tied to a particular benchmark. And I guess really what you're offering people is you're offering people to have the same journey as very wealthy families would get through groups like whether it's Hansa, whether it's Caledonia, whether it's ROT. So clearly those are the kind of names that we would look at, and I say they really are great funds as well.
Can I ask another question that's coming in is sort of around the fees, so that you mentioned that you're getting access to a lot of other funds that people probably wouldn't get access to directly as private investors. What happens with the fee structure of some of these funds as to how does that work and how does that sort of then get passed down the lines?
Yeah, so as I say, we historically Hansa has charged a 1% flat fee. So what we're doing, in the recognition, I think that fees generally within the market are reducing. We looked at the average across a grouping of our peer group, which came out, about 0.86 or something like that. So effectively what we did is we said, look, if we charge, let's say 0.8 on the first 500 million sterling of assets, and then 0.7 thereafter, that would bring, if the combination was successful, that would bring the combined fee down to about 0.75. And the second part would be on the ocean side, where there was a performance fee as well, again, something which I think the market is increasingly kind of less keen on. So again, we decided to stop the performance fee and remove that as well. Now, in terms of the grouping that we invest in, clearly as as you manage slightly more assets, you can look to kind of negotiate your fees. So again, by having a scale of assets that's not too large that you can't invest, but having enough kind of say that you can go to people and say, look, let's talk about fees and let's try and ensure that we always have the least possible fees, which is what we try and do. But otherwise, we think about funds on a net basis. So if you're investing, I don't know, in venture capital, with the best will in the world, you are not going to negotiate your fees with someone like Coase or Mayfield. However, we look entirely at their net performance, post fees, and that's entirely what. So we're very happy paying higher fees. We just want to ensure that the return you're getting post those fees justify, what we're doing, what we're paying for them.
Okay, oh, that's good. Could you? There's a lot of talk in the markets now about de-equitization. What does that mean? Numbers of listed companies are getting smaller. And private equity is on a, is on a march. What do you see coming down the road, and how do you get involved more deeply in understanding and the decisions that are going on in your private equity holdings?
Yeah. So yeah, I mean, so you're absolutely right, Fraser. That what we've observed over the years is that companies increasingly, historically, they would have got to a certain size, and as quickly as possible, they would have sought capital via the public markets. I think because of the regulation that we've been seeing within the public markets, the amount of red tape that companies have had to deal with in terms of running their companies, and also I think just the fact that that often they are required to be short term in running themselves within a public kind of sphere and space.
Yep.
Increasingly, if you can get access and you're a company to private capital, which gives you more flexibility, you don't have the same degree of regulation, the same degree of red tape. More and more companies, we think, will stay within the private space. So we think by having exposure to private equity will give you, enable you to play those assets and to benefit from that trend. And if you're not playing that, we think you're missing out on a huge part of the market. And and we can see that. You can look through markets, particularly the UK market, which is suffering from a dearth of capital. You're finding more and more companies are just not seeing the value recognition that we think they perhaps should be seeing in the market, and which is why also you're seeing more and more groups move into the US. It's not just the entrepreneurship that you're seeing within the US market, but the depth of capital markets within the US, which is why you're seeing many great names move into the US if you can do that.
Yes, thank you. Another trend that we're all experiencing is the sort of active versus passive, the growth of ETFs. Where do investment trusts sit in that space versus the ETFs, and then what do you think is special about Hansa that makes you stand out against the sort of passive onslaught?
Yeah. Okay. So I guess having been an active manager all my life, I'm willing active management on this one. So I start from a kind of a pro kind of active management perspective. Unfortunately, it's clearly the case that certain markets, like the US market, for example, outperforming the US market is very hard. It's very challenging. So we're agnostic on this, and we say, look, we recognise it's hard to outperform in the US market, and therefore we're very happy to have a passive exposure to the US market. And I think the only way of outperforming in markets like the US is doing something very active. You can't be a quasi tracker. You can't be trying to kind of do the market plus or minus 1-2% over a year. You have to be very different from the market. And unfortunately, that does come at a cost, in the sense that certain years you will probably significantly underperform the US market. But our view is that, again, by being a long-term investor, using the length of our horizon, if we believe in their process, if we believe in what they do, we think that that will pay dividends over the long term. So again, that's something which I think a group like Hansa has the advantage on, that we're just not, we're just not required to be short term. People know we're long term, and therefore we can see through those periods of disappointment. In terms of why a shareholder an investor would come to a group like us, I think if you are either a wealth manager or if you're a self-select investor, having exposure to, say, an MSCI World or an S&P, and then having someone like Hansa, which gives you something genuinely different from the market, gives you exposure to private assets, a high conviction direct global investments. Fun enough, I think, that kind of barbell approach would make a lot of sense for many investors. So that's what we're trying to be. We're not trying to, we're not going to be for everyone, but we're not trying to replicate the market. And I think to a lot of people, we'll offer something quite compelling, quite interesting that you just can't get elsewhere.
I think that's definitely true. But another one that's another questions that's come up is as a long-term investor, and again, I know that the family connectivity within all of this is a big part of this is about managing risk, sensibly managing risk. So, there's as much risk if you're going to get in something long-term, you really are embedded with some of these ideas. With the enlarged group, what how's that going to change, and or is it, or how are you going to accommodate being a slightly bigger group as to managing that risk?
Yeah, so we think a lot about risk already. So I don't think there's necessarily anything we'll have to do differently in the future than where we are now. Funnily enough, by being a slightly larger group will give us more, I think, kind of meaningfulness in certain investments. So if you're investing in, I don't know, TA associates in the private equity market, they require a minimum ticket size before you can kind of almost be allowed in the club. So by having more assets, I think, strengthens our position there. We are nowhere near the point where, in my old shop of running money for very large groups, whereby your scale becomes a substantial detriment to what you're doing. We're nowhere near that kind of level. So I don't think that impacts us actually. In terms of managing risk, say our first port of call, I think, is having managers who are highly experienced. So if you've got a manager who's managed through multiple investment cycles, pick on a name, I don't know, someone like Sam Beck at BlackRock, multiple investment cycles in emerging and frontier markets, fully knows the risks of what he's facing, is well versed in managing those. So that's, I think, our first point where we manage risk. Secondly, by blending private assets with public assets, again, they typically operate on different cycles as lags there, and again, that gives us some diversification. We have a diversifying silo, which gives us the capacity, if we were particularly worried there was some structural issue, we were worried about, I don't know, excessive kind of debt levels in governments, etc. We can extend that bit as well, so we can dynamically manage that. And then finally, I think just the operating side, clearly in a world where there are issues in terms of Russia, China, etc., you want to make very clear that your managers are managing their operational risks within the fund as well. So we try and have a kind of a multi-pronged approach to managing these risks. And it is important, if you're running a private equity portfolio, which, is a 10-year plus portfolio, you need to get your due diligence right, because once you're in there for the journey. So if you're not doing this well and not thinking about it very, very carefully, you can be locked in for a very protracted period of time, and it's not easy to get out of them. So it's absolutely something that you do need to think about.
Thank you. That's there's a couple more questions that I've got that are coming in. One is, it is an interesting point you're saying about the good or the excellent global performance with a deliberate point that you separate. You're not looking to just track the Mag 7, which has been the driver of US performance there, absolutely. What 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 other themes are you looking to follow? Mega trends or ideas? Like Mag 7 is very much tech focused, isn't it?
Yeah,
What else are you looking at?
so we we have been playing technology quite heavily, and clearly, really, the only game in town was the Magnificent Seven, and I think we sit at a fork in the road at the moment. That clearly, I think AI will change. I think it is and will change the world. I think it will change how we operate, how different businesses work. There'll be winners, there'll be losers from it. The question you've got for the Magnificent Seven themselves is whether or not the capital that they've invested, a little bit like whether it was cable in the past or mobile telephony, that they invest so much money within it that the returns that you get from it don't justify the kind of valuations they're on. And that, I think, is something which is up for debate. And funnily enough, that's why I think it leads us to these venture capital groups. So really what these venture groups are doing is that they are cutting edge investors within AI, for example. They are identifying what they think will be the great names of the future. Some will be successful, many won't. But the important bit is that when you've got the Magnificent Seven, for example, out there trying to acquire anything that they think will be a threat to their business or a help to their business in the future, the venture groups really don't care, in the sense that if you've got something that's looking successful, someone like Microsoft comes along, buys that business, and they make their return, even if it's not successful in the future, they've kind of done their job. So in a funny sort of way, we like technology, but we're increasingly focused on the venture side of it rather than necessarily that Mag 7 side, given the question marks about whether they'll make a return or not. So that's one thing we're doing. Insurance is something that we played at the beginning of last year. We did it in multiple ways. We thought pricing was attractive. As ever in insurance, it's normally a capital cycle question. Capital was withdrawn heavily through multiple years of kind of events happening. And I'm sure, and we've done wonderfully from it, and I'm sure at some point capital will flow back in again and we will exit at that point, because that will invariably drive down returns. So we've done insurance, but that will be a cycle one. The other one, which has been more mixed, is biotechnology. We've got a group, we've got a couple of groups. One of them, RA Capital, in Boston-based biotechnology manager, and wonderful group, wonderful long-term track record, has at this stage hasn't worked hugely well of late, because you've had concerns over drug pricing, you've had concerns over, kind of finding of drugs, you've had concerns about, kind of interest rates going up affecting long duration sectors. So that one we think is attractive still, albeit it hasn't of late worked particularly well. But again, we're relying on a long-term investment horizon, and we are sticking with that one at this point.
Well, that kind of follows your opening remarks. I've got time for one more question. Alec, you're very much the sort of front of the trust and the fund, but I know there's a much deeper team of experts there doing the work, shall I say, or certainly helping you. Could you just tell us a little bit more about who else is there alongside you, and how does the sort of strategic allocation body work? How do you, when you're making some very big calls for the fund, how does that actually come through?
So
that'll be our last question.
Yeah, so we've got Rob Royal running the direct global equity part, has done just a fabulous job. So Rob is very much focused on that side, but also contributes to the broader discussion. So by having, for example, a view on equity markets, looking at things almost from a bottom-up perspective, brings a extraordinarily helpful conversation to our asset allocation, what we're doing there. We then have George Clifton Brown on the team. And again, what they're doing is they're very much focused on asset allocation, which areas of the market do we like or not like, which countries do we like, which themes do we like, and also then the fulfillment of it. So much of that time is then spent saying, okay, we like emerging markets, so we're looking more at emerging markets at the moment. Who are the very best managers in the market at the moment? What are they doing? And then we're putting it through, a very strict, very defined due diligence process. And then what we're then doing is that, I might have the ultimate say on things, but actually at the end of it, because the process is almost dictating what's happening, it's really kind of an agreed decision at the end of it. So it's all kind of working as one. We've then got Will Lewis doing a very similar job to George on that side. We've also got Henry again helping on that side. So there's a team there. We've got Chris Townsend on the private equity side doing lots of work for us there. So it is it is very much a team approach. And I say I might front it, might have the final say, but it's really a discussion-based collegiate approach of what we're applying.
Excellent, thank you. Well, I'm going to wrap it up here. I think we're heading to the end of our scheduled time. Alec, that's been absolutely fantastic. It's a very positive run through of the trust, of your thoughts about the market, and gives us a lot of confidence as to where you're taking the investments. I also appreciate, and for our guests, you might not have got everything answered, and with the deal going through, there are some things that we weren't able to answer. But please do, if you'd like to, you can contact Alec directly, or the chairman, Jonathan Davey, if you need those questions answered more immediately. Otherwise, we'll perhaps look to run another webinar once everything has gone through and you've done a little bit of integration with the two companies, and then you can talk much more to that. But Alec, thank you. Great run through.
Thank you.
Everyone on the webinar, you can find more detail on Hansa's own website or on the Edison website. And if you'd like to speak to any of our analysts, then do please contact them directly, and we'll be able to follow up. But with that, thanks very much to everybody who's joined us for asking all those questions, some excellent questions, and Alec for running us through the fund.
Thank you. Thank you, Fraser. Thank you all. Thank you.
Bye, everybody. Thank you.